Something unusual just happened in the global financial system, and almost nobody is explaining it clearly. In the last 24 hours, a sudden move out of Japan sent ripples through currency markets. The Japanese yen moved sharply. The US dollar reacted. And at the same time, gold made a strong push upward. Now, on the surface, this might look like just another normal market fluctuation. But here's the strange part. These three things don't usually move like this at the same time unless something bigger is happening behind the scenes. So the real question is, did Japan just intervene to support its currency? Why did the dollar react so quickly? And why are investors suddenly paying attention to gold again? In today's video, we're going to break this down step by step, what likely happened, why it matters, and what it could mean going forward. Because once you understand the mechanics behind this move, you'll start to see the global financial system very differently. To understand the situation, we need to start with Japan. For years, Japan has followed a very different strategy compared to other major economies. While countries like the United States raised interest rates to fight inflation, Japan kept rates extremely low. Now, that decision had a side effect. Investors around the world began moving their money out of the Japanese yen and into currencies offering higher returns, especially the US dollar. And when large amounts of money leave a currency, its value naturally weakens. That's exactly what we've been seeing. The yen has been under consistent pressure for a long time. Now here's where things get interesting. When a currency weakens too much, it can start creating real problems inside a country, like higher import costs and reduced purchasing power. So sometimes governments step in. This is called currency intervention. It usually involves selling foreign reserves like US dollars and buying back their own currency to stabilize it. And based on recent market behavior, many analysts believe that Japan may have done exactly that. Nothing is officially confirmed in real time, but the sudden sharp movement in the yen strongly suggests that some form of intervention likely took place. And when a major economy like Japan makes a move like this, it doesn't stay isolated. It sends shockwaves across the entire global market. Once you understand how currency intervention works, the next part becomes much easier to see. If Japan stepped in to support the yen, they likely had to sell a portion of their foreign reserves. And a large share of those reserves is held in US dollars and US government bonds. Now, think about what that means in simple terms. When a major player like Japan starts selling dollars, even partially, it increases the supply of dollars in the market. And when supply rises quickly, even in the short term, prices can react. That's why we saw a noticeable move in the US dollar around the same time. It wasn't random, it was part of a chain reaction. But here's where it gets more interesting. The global currency system isn't just about one country versus another, it's deeply interconnected. Movements in one major currency, especially from a country like Japan, can influence everything from exchange rates to bond markets to investor sentiment around the world. Now, let's zoom out for a second. Over the past few years, we've been in a very unusual environment. Different countries are following very different economic strategies at the same time. Some are keeping interest rates high, others are trying to support growth with lower rates, and some are navigating the balance between inflation and stability. This creates tension inside the global system, because money is always moving, searching for the best balance between safety and return. And when those differences become too large, pressure starts to build. Currencies begin to shift more aggressively. Capital flows become less stable, and markets start reacting faster to even small signals. That's exactly why a move like this, even if temporary, gets so much attention. It's not just about Japan. It's about what this kind of action represents. It shows that major economies are actively managing their currencies in response to global pressures, not in a dramatic or chaotic way, but in a controlled, strategic way. Now, it's important to stay grounded here. This doesn't mean the system is breaking or collapsing. Global financial markets are designed to handle fluctuations like this, but it does highlight something important. The system is becoming more sensitive. Reactions are becoming faster, and coordination between economies is more important than ever. And this brings us to the next key piece of the puzzle. Because while currencies were reacting, another asset quietly started gaining attention. Gold, not in a dramatic or extreme way, but in a way that signals something deeper about how investors are thinking right now. Now let's talk about the part that caught a lot of attention, the movement in gold. When currencies start shifting quickly, investors naturally begin asking one question. Where do I store value in uncertain moments? And historically, gold has often been part of that conversation. But to really understand this, we need to clear up a common misconception. Gold doesn't move randomly. It tends to react to a combination of factors, especially currency strength, interest rates, and overall market confidence. Let's break that down simply. When the US dollar is very strong, gold often struggles. Why? Because gold is priced in dollars. So when the dollar rises, gold becomes more expensive for global buyers. But when the dollar weakens even slightly, that pressure starts to ease. And that's exactly what we saw. As the dollar reacted to the situation involving Japan, gold began to move upward. Not in isolation, but as part of the broader shift happening across markets. Now, there's another layer to this. Gold is often viewed as a stability asset, not because it always goes up, but because it behaves differently from currencies and stocks in certain situations. When uncertainty increases, whether it's economic, financial, or geopolitical, some investors begin reallocating a portion of their portfolios. Not all, not dramatically, but gradually. And that shift in behavior is important, because markets are not just driven by numbers, they're driven by perception. If enough participants begin to feel that conditions are becoming less predictable, even small changes in positioning can create noticeable price movement. That's why gold's reaction matters here. It's not just about the price itself, it's about what the movement represents. It suggests that some investors are becoming more attentive to shifts happening in the background of the global system. Now, let's keep this balanced. A move in gold over a short period doesn't automatically signal a long-term trend. Markets move for many reasons. Currency fluctuations, interest rate expectations, inflation data, global events. So it's always important to avoid jumping to conclusions based on one move. But at the same time, moments like this tend to act as signals, not loud, dramatic signals, but subtle ones. They tell you where attention is starting to shift. And right now, the pattern is becoming clearer. Currency markets are reacting faster. Central banks are making more visible adjustments. And investors are watching alternative assets more closely. This doesn't mean something extreme is about to happen, but it does suggest that the global financial environment is becoming more dynamic and interconnected than ever before. And that leads us to the most important part of this entire discussion. Because once you put all these pieces together, Japan's potential intervention, the dollar's reaction, and gold's movement, you start to see a much bigger picture forming. Now that we've broken everything down step by step, let's connect the dots. We started with a sudden move in the Japanese yen, which many believe was driven by possible intervention. That led to a reaction in the US dollar, as global currency flows adjusted in real time, and alongside that, we saw gold begin to gain attention again. Individually, each of these movements is understandable, but together, they tell a much more important story. They highlight just how interconnected the global financial system really is. Today, no major economy operates in isolation. A policy decision in one country can influence currency markets in another, which can then ripple into commodities, bonds, and even equity markets. And because information travels instantly, these reactions now happen faster than ever before. This is the environment we're living in right now. Highly connected, constantly adjusting, and increasingly sensitive to change. Now, it's important to keep perspective. Movements like this don't necessarily signal a crisis. Financial systems are designed to adapt, absorb shocks, and continue functioning through periods of volatility. Central banks, institutions, and global markets have tools to manage these situations. But what is changing is the speed and frequency of these shifts. What used to take weeks or months to unfold can now happen within hours. And that means awareness matters more than ever. Because when you start paying attention to patterns like this, you begin to notice something powerful. Markets don't move randomly. They respond to incentives, pressure, and expectations, and those forces are constantly evolving. For viewers and observers, this creates an opportunity not necessarily to predict every move, but to better understand the landscape. Instead of reacting emotionally to headlines, you can start seeing the structure behind them. For example, when currencies move sharply, you can ask, is this policy-driven? Is it market-driven? Or is it a combination of both? When assets like gold start gaining attention, you can consider, is this short-term positioning or a shift in broader sentiment? These are the kinds of questions that separate casual observers from informed viewers. Now, let's be clear about one thing. This video is not about telling you what to buy, sell, or hold. It's about helping you understand what's happening so you can interpret these events more clearly on your own. Because in today's environment, clarity is more valuable than ever. And if there's one key takeaway from everything we discussed, it's this. Small signals can reveal bigger shifts. And the more you understand those signals, the more confident you become in navigating uncertainty. So going forward, keep an eye on these three areas: currency movements, central bank actions, and how different assets respond to both. Because that's where the real story usually begins. If you found this breakdown helpful, let me know your thoughts in the comments, especially what you think about Japan's recent move and how it might play out from here. And if you want more clear, no-hype explanations of what's happening in the global economy, make sure to like the video and subscribe to the channel, because these shifts aren't slowing down anytime soon, and staying informed might be one of the most valuable advantages you can have.